Hey, it's Cory, Boldroff, the real estate guy, bringing you another monthly market update. This is September of 2022, bringing you real stats and facts and opinions from expert and housing economists from around the country so that you can be informed and make the best educated decision with one of the biggest investments of your life, which is real estate. I know some of us use our aunts and our uncles and our nephews for real estate, but realistically, you need to use someone or at least listen to someone who is an expert and can share their experience and knowledge and really understands the real estate market. Because again, this is one of your biggest investments. So with no further ado, let's get into it. So we're going to cover these topics today: mortgage rate projections, home prices, will prices plunge like the Great Recession, affordability, and then also we're going to cover one last big, huge warning sign that is happening right now, and we need to do something to stop it. So as we know, this year, the real estate market has really been defined by the huge increase in mortgage rates and what it's been doing to buyers' affordability and what it's been doing to the home prices itself. So let's give a little bit look into the mortgage rates. From the beginning of the year, we're at 3.22. Last year, we actually hit one of the lowest ever in our country for a 30-year rate mortgage, which is right in the mid-twos, 2.68, I think it was. This year, we've had one of the highest increase in spikes in history for mortgage rates for a 30-year fix. We started at 3.22 and we got all the way up to 5.81, and some markets even hit above 6. Since June, we've been kind of roller coastering up and down, just depending on the volatility of the market, what the feds are saying, and kind of what's happening with Wall Street and the real estate market itself. But when we look at mortgage rate projections, the big, huge banks, they kind of foresee that over the next couple of months and the next quarters into 2023, mortgage rates have stabilized, and they see them stabilizing and starting to hedge down. We all know the feds keep raising the rates to kind of combat inflation. It's done very, very little to inflation, but it's definitely stopped and slowed down the real estate buyer frenzy that was going on, which we did need. We did need to stop the toilet paper monkey buying that was going on. It was not sustainable for the housing market to go up by 19 to 30%, depending on which market you are in. At the end of the summer lull, and as mortgage rates stabilize, we may see a return of buyers in a relatively strong fall housing market, according to Lisa, the housing economist. So what we do know is that right now, buyer demand is at an all-time low. A lot of it is because buyers that were in the market looking for homes got really discouraged of the 2021 markets, of getting overbid by 100,000 and trying to take advantage of those low rates. Some buyers even waiting, thinking that house prices were going to come down. Houses prices have gone up, and rates have definitely gone up. So their buying and purchasing power went down. But we still have buyers buying in this market. We still have sellers selling in this market. So it's still a good time to buy. It's still a good time to sell. Remember, when you buy a house, you can always refinance the rate later at a lower rate if it comes to. So let's switch over into home price appreciation. So again, as we know, everywhere on the media, they're saying the market is crashing. We're going to come into another 2008 Great Recession crash. Housing prices are plummeting. But that's really just not the case if you actually look at the real stats and real facts. So let's get into it. So according to Mark Zandi, chief economist of Moody's Analytics, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country, especially in inflated markets. So usually in the West Coast, especially Southern California, when the market does start to shift, we are the first ones to see the shift happen because our home prices are the highest. And when you base median price versus median income, we usually have a higher offset than the rest of the country. So when we look at this year, what we're seeing is appreciation is slowing and it's not actually depreciating. So when we look at home appreciation, it's calculated in a couple ways. Right now, what we're looking at is year over year, the percentage and change of prices. So in the beginning of January 2022, we saw a 19.1% appreciation from last January. home prices that have actually sold. Then we saw almost a peak in March of 20.9% appreciation growth from last year. We're starting to see a deceleration in prices. So yes, a home that sold maybe in July might sell a little less in August, or have sold a little less in August, but not compared to last August. So what we've got to do is keep an eye on this deceleration and see if at a certain point in time we see an actual depreciation. Some markets might see it again, but we're not going to have this Great Recession housing crash that everyone is calling for. Annual home price growth slowed for the third consecutive month in July, but remained elevated at 15.8%. As a 30-year fixed rate mortgage neared 6% this summer, some prospective home buyers hold back, helping ease overheated and unsustainable price growth. Looking ahead, CoreLogic expects to see a more balanced housing market, with year-over-year appreciation slowing to 3.8% by July of 2023. So it's going to appear that the market is coming to a halt, the prices are plummeting, but realistically, when you start looking at prices year over year, we're just going to see a major slowdown. What also we're going to see is that the homes that are in, are distressed, or might not be in the ideal location, or might have a distressed home seller. They lost their job, they got sick, something of that nature happened. We might see a panic sell happen, and that house actually selling for less than it did this time last year. But in overall, even in Southern California, we're not going to see this housing Great Recession prices. And we'll go into that. What I do want to say is list price is very, very important. If sellers actually want to sell, you have to list your house lower than your competition and start getting as many buyers and active buyers that are possibly looking to come see your home. If you're overpriced, they're not going to come see your home. Or if they do, they're going to use it to compare to the other home that they can buy cheaper. Many experts raise home price forecasts. So what we looked at is the 6 major institutionals: Fannie Mae, Freddie Mac, the National Association of Realtors, Mortgage Banking Associations, the Home Price Expectation Survey. And they, in the beginning of the year, had roughly around a 5.1% appreciation that was going to happen in 2022. They've actually raised, most of them almost even doubled, their guesstimate of the appreciation we're going to see in 2022. And largely in part because the inventory that was expected to come onto the market did not come onto the market. So what a lot of homeowners and home sellers decided is, like, I have a lot of equity in my home, and right now might not be the best time to sell, or even if I do sell, my interest rate is going to double, so it doesn't make it an ideal time to sell and then buy. So they didn't put their houses on the market. A lot of buyers that were in demand aren't into the market right now, so houses aren't selling as fast as, or as high, as fast as, or often as they were this time last year. We're more than likely going to see an appreciation. So if you're waiting for the market to crash, you might be waiting a lot longer than you think. And if you don't think it's affordable today, you might hate yourself in a couple of years from now, because it's probably not going to get more affordable unless interest rates start coming back down, which, if they do, is going to cause another frenzy. So again, when we look at home price forecasts, we see an average of 11.3%, which is almost double than what we saw, or it was expected, in the beginning of the year. Again, this is nationally. Some markets will be different. If you want a market update specifically for your neighborhood, give me a call. We can help you. So one of the questions that I keep getting is, will the prices plunge like the Great Recession? Are we coming into a bubble? Is it the market crashing? What's going on with the market? So I wanted to dive in here a little bit deeper. One, I've gone over the stats of it, but just simply put, this is nothing like the housing crash of the Great Recession. During the Great Recession, the market was basically an inflated, market made of straw, okay? The banks, Wall Street, the government, even homeowners themselves were all responsible in this false market and the bubble happening that happened in the 2008 crash. When we look at it, 40% of all mortgages own less than 10%. 31% were actually underwater, meaning they owed more than their houses were worth. When we look at the adjustable rate mortgages, a majority of homeowners had an adjustable rate mortgage. So when the rates went up, their payments doubled and tripled. Just like right now, while the rates went up, the homeowners weren't affected. It was very, very easy to qualify. There was people that were dogs, people that were dead, that were getting home loans during the 2004 to up to the 2008 crash. Right now, that's not the case. So when we look at today's housing stock, we are the strongest that we've been in decades, maybe even in the history of our country. Right now, we are extremely, extremely strong. 30% of homeowners have no mortgage. Over 65% own 50% or more, and over 90% own at least 20% of their home. So even if they were in a dire situation to have to sell, there's going to be enough equity where they don't have to panic sell and they can sell their home and walk away in a good situation. Right now, we have the highest equity almost ever in the history of our country. There's over $17 trillion of capital equity, meaning up to 80%. We need that money to start moving again, which right now we're at a standstill. But again, it's because a lot of home sellers are going, well, why would I sell? I still got equity in my home. I'm sitting pretty, nothing else. Maybe I take a home equity line of credit and I ride this market out until interest rates come back down. And because of those things, what we're seeing is the tight home sales inventory. So in the 2004 to 2008 crash, we had over 4 million homes on the market. That was basically the peak. Since then, we've seen a gradual decline in inventory. More people retire in their homes, stay in their homes, build ADUs now, and have their family move in, even keep their home, rent it out, and maybe buy another one. So inventory is at a historic low. We're actually right around 1 million homes, active homes in the market. And this is what's causing a lot of the price appreciation, which comes into supply versus demand. So right now, supply is very, very low, which is causing prices to be high. But also what we're seeing is demand is also low, which is making so those houses that are on the market are not selling. A lot of that, again, has become due to buyer demand is tied to interest rates. We had historically low interest rates. Now they're below the average, the 30-year average, but still 2 to 3 times higher than they were at this time last year. So it's making buyers be a little bit more hesitant, maybe not be able to afford. Their purchasing power has gone down. So what we are seeing is there's been a huge uptick in hedge funds, Wall Street, institutional buyers, investors buying up all the single family residences and then renting it because rent has gone up by 10 to 18% just in 1 year. So it's a lot of times even paying the mortgage. Or if you're a hedge fund, you buy it all cash. Let's say you bought an $800,000 house, you're able to rent it out for $4,200. You're making 5% cash flow positive on your money. Plus, you're making a 4% appreciation or 11% appreciation if the guesstimate is correct. You can't get that kind of return in any other market. So we're starting to see a lot of money coming out of Wall Street, out of the stocks, out of the mutual funds, and start buying up and gobbling up the single family residences. So when we look at, again, another way of looking at the differences between the Great Recession and today, the average FICO was a 681 in 2006. And actually, there was a huge majority or a huge portion, over 33%, actually had a 660 and lower. Today, our FICO is 745, and the mortgages that have a 660 and lower are less than 5%. So there's a much stronger buyer and homeowner that owns the homes today than did in the 2006 crash. This kind of shows you how that looks like in real numbers. When we look at capital equity, $17 trillion in equity over 12 and a half is tappable. It's just a huge difference from what we were in 2006, which was less than 6 trillion. So with all that said, let's go into affordability, because I know that's a huge portion of why buyers aren't able to buy or they're hesitating to buy right now. Number one, so we look at the affordability index. This is from 1999 to today. And we see that the higher the bar is, the more affordable the house is. And this is compared to the median income of a price of a home, to the median income that the homeowners have. So we had a peak after the 2008 crash, about 2011, 2012. We had one of the highest numbers that we've seen. Housing prices were at an all-time low. Rates were starting to head back down. And we've kind of seen a decline and then a kind of roller coaster over the last 5 years. Right now, because interest rates spiked so fast and so high, and the home prices haven't come down to adjust that yet, we've seen you right under 100%. So the median income of a homeowner or buyer and the median income average price, or the median average price of a home, when it's 100%, it's equal. So we're right below being equal. So yes, it's a little bit more hard, a little harder to get approved. You're spending a little bit more money towards your mortgage payment than you were in the past, and making it less affordable. Compared to 1 year ago, the monthly mortgage rose from 1944 from 1265, an increase of 53.7%. So this is obviously huge. What you could afford has definitely gone down. Every 100,000 is about $600 in monthly payment. So if you were able to afford a $600,000 house, you're more than likely only able to afford a $500,000 house right now. So if you didn't like those homes that are on the market for 600,000, you're probably really not going to like the homes that were on for 500,000. And this is what's causing the price reductions, and sellers that really want to sell right now to have to adjust their prices just to meet buyers' affordability. When we look at the monthly mortgage payments increasing, again, this is from 2020 till today. We've seen a little bit of a rise, and then when the Fed start raising the rates, went up from the low threes all the way up almost to the sixes, your payments doubled, or went up by 50%. And it's definitely affected the homeowner or the home buyers. And as well as it's affected homeowners, not in their mortgage payment, but the ones that were thinking about downsizing, upsizing. Unless you were thinking about moving out of state or completely out of your area to a much affordable price, it probably doesn't make too much sense. When we look at the mortgage payment to income ratio, this assumes a 30-year fixed rate mortgage with 20% down payment on a median price home with a median income, principal and interest payment to income. So we were below. It was taken about in 2000, it was about 19.6% of your income to buy a home. Today we're at 25.4%. Now the banks will allow you to go up to 36%, but then you have to have a really low debt to income ratio for all the other things that are on your credit, your car, your credit cards, any loans that are actually on your credit report. So median income, household income versus qualifying income. So this is nationwide. We see that the median income is slightly below what it needs to be for qualifying income, or median income versus median house price. In the Northeast, so actually you have a little bit more income versus the median income price. When we look at the Midwest, that's probably your most affordable area right now, is the Midwest. A lot of people are moving to Texas and Arizona, and those type of areas. Then we see the South, it's almost identical. And then when you're on the West Coast, we have the largest, difference, housing prices compared to the median income. There's just such a big disconnect that it's making it so a lot of people that are in Southern California cannot actually even get qualified to buy a home unless they're going to move completely outside of the area. And why we've seen a lot of people moving from Southern California out of the state. So 3 things that you could do. 1, expand your search area and criteria. Okay. Another thing that you could do is, if you're not a homeowner, maybe look to buying an investment property first. Go look in a more affordable area where the mortgage payment or the rent payment could be over the mortgage payment, And that way, at least you're getting home ownership, you're having the tax advantages of home ownership, you're getting the appreciation of home ownership, but you're allowing someone else to pay your mortgage just like you're paying your landlord's mortgage. Or look into like a 2 to 4 unit property where you're going to go in one of the units and rent out the other 3 units. Explore alternative finance options. So houses that have been sitting in the market, sometimes what I've been able to do with my buyers is offer a seller finance situation where the seller can ultimately net a lot more by seller financing and becoming the bank. Yes, you usually have to put down 5-10% down, sometimes even 20% down. But for a homeowner that doesn't need the income or the equity, a lot of times makes a lot of sense to them. Also, you can look for grants, gift funds, down payment resource is another way to look for those options. Or be creative. Maybe 2 buyers go in together and buy a house that has a ADU and a single family together, or a 2 unit together, or a 3 unit together. There's no limit to how many buyers can go in on a house as long as it makes sense, or you're doing it as an investment group. So if you're looking for good investments, I search all across the country for great positive cash flow investment opportunities. Just found a 7-unit mobile home park out in the middle of nowhere, and it's going to bring me $2,300 a month in positive income. I found another one in Tennessee that with an Airbnb situation is going to probably bring me about $1,500 to $2,000 in monthly income, past them paying my mortgage. So those are the type of opportunities that might be willing to look into right now, because it is going to keep appreciating. And if they does decide to lower in rates, then you can lower it and even make more money at that point in time. So we are in a place where strategy discussions and planning are critically important to make sure we can thrive during these challenging times. Stay nimble, stay informed. Remember, housing is traditionally one of the first sectors to slow down as the economy shifts, but is also one of the first to rebound. So give me a call. I'm always here to help, never to pressure. I can give you guys ideas, talk through your situation, and know that I'm going to try to give you the best advice for you and not from my own pocket. Hope you guys find this useful. If you do, please share, like it. If you have any questions, give me a call. Cory Boldroff, the real estate guy. Till next time.